The downside risks for the Swiss economy remain considerable. According to President of SNB, Thomas Jordan, as the central bank met today for its latest monetary assessment meeting. Joining me down the line to discuss the potential implications of decisions and statements made is Thomas Köbel, Chief Strategist with SEB Bank. So Thomas, it was a bit of an uneventful day in regards to action from the SNB as it maintained interest rates and continued to impose their 15-month ceiling on the Swiss franc. Is this what investors were looking for?
I think this is in line with investors' expectations. There's still high uncertainty regarding the outlook for the global economy, particularly the economy in the Eurozone. And so this is weighing also on Swiss exports, and therefore the SNB I think has no alternative than to keep its monetary policy unchanged.
While the Swiss franc fell after Credit Suisse's announcement to impose negative interest rates on December 3rd, it had almost all of its losses cancelled out afterwards prior to the meeting. But how effective do you think this action will be?
Well, I think the action from the bank could lead to lower deposits in their cash clearing accounts. I think the action is only limited to those accounts. Deposits of other persons, private households, are not affected by this action. So the overall effect will be limited. I think it will also have no major impact on the exchange rate of Euro-Swiss. I think Euro-Swiss is determined by market expectations regarding the outlook for the Euro debt crisis, and so this action by UBS and Credit Suisse is only a side effect, but that is not the major play field.
Despite EU ministers reaching a consensus regarding banking supervision, do you think it's fair to say that Jordan is stuck with the current situation as economic uncertainty rolls on?
Yeah, I fully agree with Mr. Jordan. There's a lot of high uncertainty, and refinancing needs of European governments will remain extremely high in 2013. So if European politicians were slow to implement more structural reforms, I think markets could react very disappointed. And by the way, if there is a lot of unrest in the market, I don't know if the ECB will be powerful enough to limit rise in yields. So I think Mr. Jordan is right, remaining very, very cautious about the outlook for the European economy, and especially development of the debt crisis, and therefore maybe he has to buy a lot of more euros during 2013.
Some analysts have said that deflationary risks allow SNB scope to raise the ceiling to around the 120 to 130 level, whilst others believe their extensive euro purchasing means they cannot currently afford any leeway with a 120 peg. But what are your thoughts on this?
Well, I think the SNB should stick with its current minimum exchange of 120. First of all, the SNB is a central bank and not a commercial bank. It cannot go out and tell markets, today we have a minimum exchange of 120, and in 1 month's time we have 130. Yes, this is impossible. It would create a lot of uncertainty, and maybe the SNB would be accused of currency manipulation. So I think, first of all, the SNB should stick to 120. And second, if the debt crisis in the Eurozone were to worsen again in 2013, I think even with the exchange rate of 120, the SNB would be forced to buy huge amounts of euros, increasing risks in their balance sheets extraordinarily. So overall, 120 is okay.
And finally, the SNB forecasts today that the Swiss economy will expand between 1 and 1.5% next year. It sees consumer prices falling 0.1% versus a previous forecast of an increase of 0.2%. But how do you think the Swiss economy will fare in 2013?
For Switzerland, I think current projections by the SNB the SECO are okay. I think Switzerland will hold a little bit better than other European countries, but if growth in major Swiss export markets were to disappoint, I think also growth in Switzerland would be come out a little bit lower than currently expected. So downside risks predominate. Well, I think 1 to 1.2%. I think looks reasonable for 2013.
Well, that's all from Thomas and myself, but keep up to date with the reaction from the US FOMC meeting by clicking back to Dukascopy TV for an interview with my colleague Navjeet Grewal. Bye for now.